Kalimera σε όλους. Καλώς ήρθατε στο Economica. Welcome everybody to Economica, all about economics and finance. Very happy to be with you all today. If you are new around this channel, please subscribe and leave a like and a comment. And as usual, very interesting content. Today we will be going through quite few time series and quite a lot of data. But basically, what is the concept of the day? Is it the labor market responsive to inflation? What will be the future of the labor market as we get into the automation of production processes and the artificial intelligence wave? What is the future of the workforce? This is a very huge question that we are starting to think around stuff, because I can assure you with AI I can do on my own the task of 5 or 6 people, like writing, summarizing, doing videos, podcasts, doing econometric research, doing coding. And so the big question today is, what is the future of the overall workforce? So what is, for example, the future of the Phillips curve? What are the macroeconomic models that we will have to try and adapt to the future changes of technology? So the technology component into the labor market, the productivity component, and then the demographic components. Because at the end of the funfair, if and when we will have more automation of production, of production processes, whether it's an industrial capacity or a manufacturing capacity, services such as coding for, I don't know, an investment bank, or doing some accounting for any big retail or small retail services. If all this stuff is going to be slowly automated, and you have a substitution from computing power that substitutes human beings, then at the end of the funfair, who is going to pay income tax on all this stuff? Okay, so whether we find it very amazing, truly amazing that we have these technology advances, but when we start to shrink the labor, the manual and intellectual labor input into the economy, then at the end of the day, who is going to pay the income tax and create the revenues for the government? So technology is all well and good, but if on my own, at my home desk, I can substitute 5 or 6 people. I don't run a business, but I can summarize stuff, and I can generate a podcast with AI, and I can build up a YouTube video on my own. I can study econometrics on my own. I can take data just on my own. So I can write journals article on my own. I'm substituting with artificial intelligence the work of 5 or 6 people, maybe more, perhaps more. Okay, so that means that potentially on a broader scale, in the broader economy, demand for workforce will be less and less. Okay, but the less people will be necessary to be employed in the future as a labor input into the overall productive solo growth model of productive function. When we have the production function, it's capital and labor. Okay, so then we have another factor, which is the technology factor, right? So when the share of labor will start to shrink because we have automation processes, who is going to pay income tax to the state? This is a very big unknown. It's a very big unknown that I'm sure even governments, they need to start to ask themselves the question is, okay, technology, it's wonderful, but at the end of the day, who is going to pay taxes? If everything is automated and done by some sort of magic machine or artificial intelligence or automated processes in industrial production, like car producers, car manufacturing, it's all automated. If we go to Volkswagen or BMW, you see that it's all automated. So who actually is going to do the work? If citizens are not going to do the work, they will not generate an income, they will not pay taxes. So that's a huge thing. And that will open the whole divergence of debate is, should we have a universal basic income which can be created basically by a digital central bank money, and then we tokenize the money and we have what backs the central bank currency, it's all the assets. And so it will be necessary that the central bank will have to pay directly universal basic income, because in the next 50, 100 years from now, I will not be alive, but if everything is automated and we will not need to work, from where we get income and we pay income tax? So things are changing quite fast, or less rapidly, as I don't think that changes are so fast, because the economy still works a lot with it's all mostly made by human beings, by persons. But whenever we automate processes, then again, at the end of the day, who's going to pay the income tax when everything is automated by artificial intelligence? And we can see the effects of these things by the evolving of the macroeconomic framework, the monetary policy framework, the adjustment of central banks to what the shocks in the economy that we have all lived through. That it can be the financial crisis in 0709, the I don't know, the pandemic, or the inflationary shock, or the geopolitical risk, so forth and so on, or the euro area sovereign debt crisis. All those big macroeconomic shocks and have required a huge response from the monetary institutions, and so we see that in the modeling of the data, the dynamic in the economy have slightly changed, and the model tend to more sophisticated model, they tend to capture these changes and these adjustments. And then we can see how for example, what we have always known as the relation or the ratio between wages and inflation, it's something that has not stuck through the past decade or so. So because just let me just get on the charts that are important to us. So stick with me, because it's very, very interesting. And I've not only analyzed the Phillips curve or something like that. Is that the automation of process, it's likely to require less and less workforce input. So again, who's gonna pay income tax on all of that? So how the government will pretend to generate revenues? How pensions will be paid if the workforce is not only for the demographics? If the workforce input will not be required, the demand for workforce will shrink, because in a business, in a services business, I can automate accounting and Excel sheets and all that stuff that goes into the accounting and doing payrolls. And for let's say I'm an accounting business and I use Copilot, AI Copilot on my Excel sheets, I can work on my own for doing accounting for, I don't know, 10, 20, 30 retailers, and I don't need accountants. Because I plug in the data, the Excel sheet, I have the automation process, I just check out that everything is fine, and then you need human being supervision on what is the automated process, but you don't need labor input into the process of doing things. This is a deep philosophical question of doing stuff that we are completely exonerated for, and there is a huge, a very important philosopher of the 1960s and 70s, which is Gunther Anders, who wrote a couple of books which are called the obsolescence of mankind. So that basically mankind already in the 1960s, in the 1970s, these great philosophers, they saw that mankind, humanity, was becoming obsolescent, was becoming not enough technologically advanced to catch up with the actual rate of change of technology. So the automation of production, it makes the human being a tool which is not anymore useful. So what happens? For example, what happens is that in the past decade or more, we've seen that wages have been depressed and been suppressed, while inflation has been kept steady but grinding higher. And in the past 3 or 4 years, we finally have got the inflationary shock in the real economy, which has catch up with the assets price inflation or asset bubble that it's been building up in the past decade, or mostly in the past decade, probably the past 2 decades, because from the we had a financial crisis in 2007 and 2009, or 8 or 9, and then we have doubled. The market went down, but with QE we have since then we have doubled and tripled on top of that bubble. So now we have a super gigantic bubble, which is the dot-com bubble and the credit bubble all together at the same time, and this is going to be quite a revealing moment in financial markets, because many large banks, they are not as safe and sound as we pretend it to be. So we can, as I said, we have a classical production function, which says that we have a share of capital and a factor alpha, and a share of labor, let's call it labor, at time t at a factor 1 minus alpha. Okay, so the factor alpha is the proportion of allocating how much of alpha, how much of the input I allocate to capital, and how much of the production function input I allocate it to labor. So how much capital I'm using, how much labor I'm using, and indeed with the technology component of the production function. So what I was saying before is that the share, the 1 minus alpha of the share of labor that I'm going to use will be always lower and lower and lower, will be lower and lower and lower, while more and more share of the alpha factor, of the technology factor in the production function, will be allocated to the K2, the capital. So basically that means that we will be spending more on, we will be allocating more money towards the technology component that improves the capital return of the production function, rather than allocating more to the technology component that improves the labor input of the production function. In what sense? First, because we have an economy which is skewed towards services, and then we have a speculative economy, so that probably most of the people they think that it's better to play the stock market rather than doing an actual manual work. So the rate of return of capital tends to be higher than the rate of return of doing an actual job and having an income. But basically what happens is that with the automation factor in the economy, then the not so much the alpha parameter, but the labor parameter will be less and less. I'll write it again. I hope to write it properly. So we have a production function, y of t, and then we have K capital and L labor, okay? And we have a factor alpha for how much I'm gonna allocate to K and how much I'm gonna allocate to labor. But in this function, let's say we have K equals 0.5, let's say it's 50-50, okay? 50% on capital, 50% on labor. So if the technology factor is more prominent, I will allocate 70% on capital or 80% on capital and 20 or 30% on labor. So that means that the allocation in the economy, the distribution in the economy will be more and more on capital that goes towards the alpha factor, which is the technology factor, technology component, rather than the labor, because I can automate all that stuff. And again, we will have some y of t at the end of the day. It's not 50-50, it's 70-30 or 80-20, or not more than 80%, 90% would be so extreme that nobody will work. But at the end of the day, we will have an output for y, which is GDP, or the production function. We will have an output product in the economy. But the share of labor will be always less than 50%, okay, of the total output in an economy. And so that will should worry households should worry everybody, not only because we're gonna be unemployed forever. I hope not, because doing a job it's interesting as just doing research, but on a wider scale, the whole population, who's gonna work, who's gonna have an income, who's gonna pay tax on all this stuff. So that's what I'm blabbering about in the past a good half an hour or something like that. So I apologize if there are mistakes or anything of the sort. So what has been the ratio, the relation between wages and inflation? It has been very, very subdued, because we have experienced a lot of financial repression of interest rate and with QE. And so we have seen that in the past decade there has been a lot of in the past couple of years there has been a lot of inflationary shock, and so workers are demanding higher wages for inflation. But is the rate of unemployment the cause of higher prices? What we can see in these charts, definitely the rate of unemployment is not as if it were in the 1970s. It's not the major cause of a push-up in prices. Well, can be core PCE, consumer spending, or CPI, general inflation basket. So we see here that the slope of this red line, it's very, very not so steep. So it's almost like parallel to zero. Okay, so the slope, it's converging towards neutrality, or just no covariance at all between no relationship at all between unemployment and prices. So if unemployment is low, here at 4%, we have 4% inflation. But if unemployment is here at 12%, I will have 0% inflation, because we have so large scale of unemployment, nobody has an income, and so nobody goes out and spends money into the corner shop, in the off-license shop. So there is no inflation, there is no demand in the economy for goods and services. Okay, so that's the scenario with the implementation of, or with the implementing of doing everything to artificial intelligence. So there will be mass scale unemployment, because no labor input would be required. So these are the broader mechanics of the Phillips curve. So we have high inflation and low unemployment. We have high unemployment and low inflation. But we see that here the slope of the inclined slope of the linear regression, it's very, very mild. So it's very, very close to zero. If we have and we can see it here in the R square, these parameters, because they are smaller than 0.5, it's on a percentage scale. It means that the ratio between unemployment and the core consumption expenditure is 27%, 28%. It's less than 50%. The same here, the ratio between here the R square is 0.18. So it means that the ratio between the level of unemployment and the level and the CPI inflation, the broader basket of inflation, these are the United States data, it's 18%. Okay, so the level of unemployment, let's say it influences, or it has a direct relationship with the broader measure of inflation for 18%. Which is way less than 50%. It's very, very small percentages in statistical terms. When we go south of 0.5, the R squared, it does not explain a lot. So it means not the R squared, and implicitly the relation, the interaction between the two variables that we plug into the linear regression, then they don't explain a lot, okay, in the whole model. So we start to see here, we take the data from 2007 up to 2025. I was constrained because the Bureau of Labor Statistics has has some sort of limit in the data that you can plug off their database. And so we see that in the past two decades, sorry for my French, the interaction between inflation, prices, and unemployment has become mild and mild and mild. So we can have a fully functioning labor market. Like here, we see what is the slope of the regression between inflation and the employment rate. Okay, so we see that the R squared is even lower. It's 0.04. Okay, only 4% of the aggregate level of the employment for what concerns the American economy, explains what is the level of CPI. So it means that there are so many other factors into the economy. That's why we take dynamic modeling of the overall economy to make sure that we are able to understand what are the dynamics of inflation. And for instance, we know that tariffs are a dynamic of a pass-through effect for inflation that does not depend from the level of employment or unemployment. Okay, this is totally uncorrelated, because if I'm importing goods, so let's go into the, let's debunk the idea of imposing import tariffs, okay? Because if now the euro dollar, okay, exchange rate, it's 1.17, 18, okay? So that means that the dollar has lost 18% in purchasing power vis-a-vis the euro, okay? On top of that, we have to consider that there are, I don't know, 15% tariffs, let's call it 15%, okay? So what that means that the here we have a plus or minus, so the euro is 18% more expensive, and on top of that, there are 15% tariffs. So the aggregate cost for a US importer is 33% approximately, okay, on a very rough thumb measure, okay? So all this, the exchange rate and the tariffs, they have nothing to do with what is the level of unemployment or employment, okay? And something more reinforcing this mathematical, very simple fact is that nobody is going to build up a manufacturing plant tomorrow, and it's going to take 2, 3, 4, 5 years to create the industrial factory or the manufacturing plant, and so that I have more employment and I have more domestic production. So that means that the level of employment or unemployment, rightly so, they don't explain the level of prices, but what actually would explain a resurgence of inflation in the United States is this very simple fact, that, for example, the euro is 18% more expensive, the pound is 35% more expensive, and if we add 15% of tariffs that the British exporters have to fork through, or the American importers have to fork out for importing goods from Britain, then you're talking about a markup of 50%. And so basically you will have two effects. One that goes straight back to 1929, which is or 1930s, which is a dramatic slowdown in global commerce. So imports and exports in volumes will tend to decrease. So you will have a lowering, you will kill off basically production. You will kill off GDP. Okay, because if I'm importing 33% or if my cost of importing goods is 33% or 50% more higher or more expensive by 50% or 30%, I will import less stuff, and then on the other side they will have to produce more. But at the same time, I don't have the domestic capacity production to substitute all the imports that I have to make. I have made for the past 50 years. So this policy of tariffs, I'm sorry for diverging, is totally nuts, because also in the modeling we see that the level of employment and unemployment, they don't explain a lot on what is the level of prices. So I go into two big risks, which is lower GDP and higher inflation, which is all caused by a dumb fiscal policy. And it takes time to work through. Okay, I can have more revenues for custom duties. Okay, but for how long? I mean, if then the volumes of goods which are exchanged between importers and exporters, whether it's from Japan, China, Korea, or wherever in the globe, if the volume of trades shrinks, you are basically shrinking GDP, your GDP, and you are shrinking the GDP of countries around the world, which is totally bonkers. And so the causes of inflation that could be materializing in the United States is dollar depreciation and tariffs. It is definitely not something that is related to the level of employment or unemployment. What's going to happen is that if and when the economy slows down, then you will have unemployment going up or jobless claims going up. Now they are 230,000 on average. They've been around that level for quite some time. They would be 240,000 until they will be 300,000 or 500,000. Then you will scream recession. But then you should have seen this coming before, because basically you created a huge problem in the world trade commerce of things, in moving goods around, and so creating GDP. So another factor that explains why the level of employment or unemployment, they don't generally define so much on what is the level of inflation. And we have these very fascinating models that explain us with a few parameters what actually the economy does. So here we have a DSGE model estimation, which is dynamic stochastic general equilibria. So we have this dynamic sorry for my French, stochastic equation model, which basically accounts for the time component. So we have the dynamic inflation expectation at a time t, which are today, or t plus 1 or t minus 1 in the previous period, or in the future period, what are the inflation expectation, and what is the how, for example, I value consuming consuming today rather than waiting for consumption tomorrow. So here the beta parameter tells us, okay, I value $1 tomorrow 99 cents, as much as I value $1 today. So the value of my dollar today tomorrow will be 99 cents. So basically I do not spend my dollar today, so I do not prioritize immediate consumption, because tomorrow that dollar will be worth 99 cents, so I can consume tomorrow, or I can do investments tomorrow. So that means that in the modeling, the consumption factor is very, it's sort of a patient households which has a budget constraint and does not spend it all on Starbucks today or on chocolate and donuts, but basically it values the dollar and it postpones consumption, perhaps for some sort of investments. And very interestingly, we can see that from this parameter we can arrive to basically an average level of interest rate that would basically inform the central bank, not inform the central bank, it gives, whenever this stuff is done by the PhD researcher at the Federal Reserve, they will be able to see, okay, the beta is 0.99, so if I do one, if I know that 1 over beta minus 1, okay, I have 1 over 0.9924 minus 1, right? Okay, I will try to do it with a calculator, and I hope not to make mistake. If I make any mistake, I apologize in advance. So the beta will tell us what could be the neutral level of interest rate. Okay, so here we have that the quarterly level of interest rate, so this will equal 0.0076, okay, which we can consider the quarterly level of interest rate. Let me take the calculator again. Now, if we do 1 plus this parameter, 0.0076, okay, it's horrible, I need a calculator now. Okay, yes, okay, perfect. Now, if we do 0.076 plus 1, and we raise it to the 4th power, 4 quarters, we have basically, do minus 1, we have 0. Times 100, we have 3.098, let's call it 3.1%. So after doing this all arithmetic, we end up with a 3.1% level of R. The neutral level of interest rate, it would be around 3.1%, based on what? On the beta parameter of the DSGE model, which tells us, okay, the household constraint, household budget constraints tells us that we can postpone consumption because we want to do consumption tomorrow, or leisure tomorrow, or investment tomorrow. And so we have that kind of parameter that tells us something. And then we try to estimate. So we end up that the neutral level of interest rate in the economy, according to the beta parameter, which estimates the optimal parameter of the household's budget constraints, let's put it that way, it's 3.1%. Okay, and I want to. Okay, so I can cancel this. This tells us that IR, interest rate, it's 3.1%. Then we have another parameter, which is sigma. So sigma, basically, it tells us what is the risk aversion of the overall the consumer into the broader economy. Okay, so if we have a shock in prices, or a shock in employment or unemployment, or a shock in interest rate, what is the risk aversion of the consumer? And it's pretty much a standard parameter. Then we have the K parameter, the kappa parameter, which reflects exactly the slope of the Phillips curve. Now, we see here that this K parameter, it's 0.04, okay? And, okay, I'll keep it that way. It's 0.04, which is a very, very low parameter, close to zero. What that means, it means that the slope of the Phillips curve, like here and here, the ratio between the level of employment or unemployment with the CPI or PCE or consumer expenditure of the level of inflation, it's very, very mild. And we see here we have 4-week average jobless claims, and the R squared, it's very close to zero. So the slope of the curve, what we see there is called the kappa parameter, K parameter, it's 0.0447, I believe, something like that. It means that the slope of this regression line, it has an angle which is very, very close to be flat, okay? And that means that there is no very strong linear relation or ratio between the level of employment or unemployment, most importantly, and the level of inflation into the economy. Here we have some parameters that define what it has been the reaction function of the Federal Reserve in the past 2 decades. Now phi of pi, this p is pi, okay, let me, we have pi, it's called the level of inflation, pi of t, it's inflation, okay. So this reaction function phi equals 1.16, which means that vis-a-vis every 1% of pi inflation going up, we have the reaction function, it's 1.16%. Okay, so what tells us is that the Federal Reserve is very focused on inflation, okay, on the price stability mandate. But when we look at this one, phi of y, okay, now y is the y of t minus y star, which is the output gap. So that is 0. So that means that for what is my modeling, my own modeling, which by no means is perfect, is probably there is a huge margin of error, is that basically the reaction function of the output gap is 0. So the Federal Reserve is very much focused on price stability. They are focused on also on the employment, full employment, but they don't pay too much attention to the GDP component, to the output gap. They measure it, they observe it, but they don't have a monetary policy reaction to what does GDP. Okay, so they let the economy run hot. Even if the economy goes above potential, they tolerate a very large positive output gap, which is tendentially is good, even if, for example, inflation is very high. Okay, so probably what happens is that they have a very large output gap, and then they don't hike interest rate because they have waited, for example, that inflation got really out of control, like 7-8%, and then they began the interest rate hiking cycle, so the tightening of monetary policy. Although they have a very positive output gap in 2021, and there were all signs that inflation was going to ripple to the economy, they did not respond here to phi of the y, okay, the output gap. They did not respond to the very positive output gap. They let it go because the economy is growing well above potential, okay. But then you end up with very high inflation, and then we see here that the reaction function of the central banks to the inflation gap is stronger. It's 1-to-1, a little bit more 1-to-1. Okay, so this parameter is very, very important. These two parameters are, which is rho of R and U. You can imagine that U it's unemployment and R it's interest rate. So the rho parameter measures the persistency of an interest rate shock or an unemployment rate shock into the economy, and it basically measures the persistency of this shock into the economy. We see that the rho of U it's 0.85, there's an 85% persistency, or basically it's very close to 1. So for every unit of shock into the unemployment rate, we have a 0.85% persistency. What that means is that when we have a recession, basically, and the unemployment rate starts to creep higher and it goes to 5, 6, 7, 10, 12, wherever you want to go, then the time for the unemployment shock to recover, it takes a long time because there is a lot of persistency in the modeling into the economy. The same is for interest rate. It takes a long time to go from zero. We have, for example, zero interest rate for a long time. It took more than a decade for interest rate to normalize. And we jumped from 0 to 5.5% in a matter of months. And so the same is now, central banks, they are finding difficult to normalize interest rate because there is a persistency of the interest rate shock across the economy, because there is a persistence of inflation, there are problems in the fiscal policy domain, and so it's difficult for the central bank to normalize the level of interest rate. Although we will see that the level of interest rate is a component of inflation, and it's a component, it has a correlation also with employment and unemployment. And so there is a trade-off between what is the level of interest rate or what is the level of money supply, and then what happens dynamically, what happens to people finding work or people going to shop and see their prices, they are going up or down, or they are not changing, basically. Now, what we see here, okay, is in fact, I said the log likelihood, it's huge. So probably the likelihood that the parameter corresponds to the actual data is not very accurate. So that's why. But this is only for a demonstrative purposes. But here we see that the accuracy of the Taylor rule and the Phillips curve, it's significant. These are significant parameters for what is the root mean square error. Okay, so if we calculate the mean square error, the root mean square error, then we see that here 0.16 and 0.31, the error is very small, while instead for the Euler equation and the IS curve equation, the error is larger than 1, so the model does not fit properly. Another thing to see is that we have very large residuals, so that means that the model has some breaks. Okay, so when we basically isolate the error from the modeling and the data, still we have some residual error, let's put it that way, and this residual error, whenever they are larger than 0.5, it means that you have white noise into the model, so there are residual error that make the model unstable, or the output would not actually reflect precisely what happens into the economy. That's why these are theoretical models. Moving forward, we go and estimate the new Keynesian Phillips curve, because we want to know what basically what the economy does, what the Phillips curve does, also on the back of other parameters. Okay, so we want to, the basic model that we have here, we have the hybrid model. Okay, so the basic model of the Phillips curve, it tells us the rate of inflation is this beta parameter that we have in the dynamic also we have in dynamic stochastic general equation parameter, and we have the expectation of inflation at time t, and inflation at time t plus 1, okay, plus k, which is the workforce component, y of t, plus u of t. Okay, so we have more parameters, and that can define the ratio between the level of prices, inflation here, and some sort of level of employment, or not production function, but the k parameter, I made a mistake, is the slope between the level of prices and the level of unemployment. So we have the slope parameter that is multiplied with y of t. We know that y of t is our production function, which is a of k plus L. Okay, let's put it that way. Although it's a very bad production function, I'm sure that I'm missing out on something. No, it's not plus, it's multiplied. But anyway, there is no plus here. Okay, so but y of t, this y of t here is this y of t, the same. So k is the slope of the production function, a, k, and L. And then we have the alpha parameter, which is the technology component, how much technology I allocate to capital or to labor, and how much share of labor or capital I utilize into the production function. So this one here is the basic new Keynesian NKPC, the Phillips Curve model. Then we have some hybrid model, which are very helpful for us to understand how other parameters that work in the Phillips Curve construct can explain what happens in this wonderful interaction between inflation and employment or unemployment. So here what we have, that the beta parameter here is 0.99, and the k parameter, the slope, it's very close to 0. So we have a very flat Phillips curve. The log likelihood is small, so it's good. Also we see here model fit diagnostics, so we measure what is the standard deviation of the residual error and what is the mean absolute error or the root mean square error, and those are small parameters. So it tells us that the model fits properly, okay, it's reliable, and so we can take into account these parameters. What these parameters tells us, the beta parameter, for example, according to the Phillips curve, is that the interest rate, the neutral level of interest rate, will be around 2.1%. Okay, so that model basically gives us another level of measuring what would be the neutral level of Fed funds. Okay, the money market neutral level of interest rate, 2.2%. Okay, and then we see what are the model residuals. Okay, we see that we have some white noise, so there are always errors, nothing is perfect. Okay, that's the DSGE model that we saw before. Now we have an hybrid Phillips curve. Okay, it's the same, but what happens is that the model, the mathematical formula changes a little bit, but the construct is always the same. You see how we measure the level of prices is pi of t, and then we have gamma f, okay, and then we have the expectation in f of inflation at period t plus 1. Then we have gamma b, the gamma parameter, so the expectation inflation of t minus 1, so in the previous period, and we have the slope times the production function. Okay, so what the hybrid model does, it creates an interaction between the forward-looking inflation expectation and the backward-looking inflation expectation. And so, in fact, we have gamma forward, gamma f, gamma b, gamma forward, gamma backward, and we see what basically this describes the, let's say, the consumer behavior towards inflation expectations. And it's pretty much is balanced, it's 50-50, okay? Gamma f 0.5, gamma b 0.49 is 50-50. But again, the k parameter, the slope parameter of the production function, k y of t, it's very close to 0. So what tells us that the slope of the curve, of the Phillips curve, instead of being like this, or instead of being, if we take into account the linear regression, instead of being very steep, it's pretty much flat. It's pretty much zero. So there is as if there is no interaction between how many people go to work and the aggregate demand in the economy that comes from employment or unemployment levels and prices. Okay, so this is all about the demand factor into the economy, how this works into the overall monetary policy framework and into describing what is the economic engine. Here the slope is very close to zero, it's pretty flat. Okay, so and the log likelihood is positive, so that's the best performing model that we have. So we get to a point where we understand that the hybrid NKPCE is probably the most precise theoretical framework that we can utilize to understand the behavior of the Phillips curve when we take the past 20 years data of employment, unemployment, personal consumption expenditure, PCE, core PCE, average jobless claims, average weekly jobless claims. We plug that stuff into an hybrid Phillips curve model, and we can find out that basically the inflation expectation, they work on the level of prices 50-50. Even if they are forward-looking or backward-looking, what was inflation 1 month ago, what do I expect to be inflation in the next month is 50-50, okay? And we have it in these two parameters. But the slope, the level of employment or unemployment, the slope of the curve is very, very flat. So there is no immediate relation between the level of demand into the economy and the level of prices. And I said before, if we take, for example, the fiscal policy of imposing custom duties and tariffs, we see that if we sum up, if we put together the dollar depreciation and tariffs, then we see that we have a potential 30 to 50% import cost shock on prices, which does not depend at all on the labor market. And so that is another exogenous component that goes to change the dynamic of inflation. Okay, so and we have the extended Phillips curve model, and basically it works the same. So we have the beta parameter, which tells us, okay, the consumer, it values consumption tomorrow as much as it values having $1 today, and we have these parameters which are the which are related to unemployment and employment, KU and KE. KU are unemployment and employment. So it's the slope factor, and basically what we see is that the parameter is very close to zero. So that explains us that the level slope interaction between what is pi of t, which is inflation, or the expectation of pi of t plus 1 in relation to the slope to k of u and k of e, okay, oh sorry, it's very close to zero. Okay, so there is no direct linear relation between the slope level in the curve of employment or unemployment towards what is inflation or even inflation expectation, which is very, very interesting, because how do we manage to measure the effectiveness of managing the demand, the aggregate demand into the economy in terms of monetary policy? Okay, so that's why tendentially we see that the reaction to the phi of y minus the output gap, okay, it's almost zero, it's neutral, because we don't have a monetary policy in today's framework, in our dynamic economic model, does not respond very strongly to the demand factor. Okay, there is no managing of aggregate demand from the central bank into the economy. What the central bank tries to do is to manage inflation and inflation expectation, and I'm not sure they do a very good job, and manage the labor market, full employment. Okay, that's for the Federal Reserve. The ECB works only with the price stability mechanism. But we must not forget, not for a second, that the price stability framework the price stability target, which is 2%, right? Not more, not less. It's basically imposed by the fiscal authority. Okay. Also for the Bank of England, it's the Chancellor of the Exchequer. Okay, it's the Treasury Minister, whatever is that apparatus that has imposed to the Bank of England, you must settle a 2% inflation, stable. But in other videos, you can go and see that in the past 35 years, average inflation in the UK has been 3.3%. So whoever was the Monetary Policy Committee or the Bank of England governor, and also the Exchequer, the Chancellor of the Exchequer, inflation has never been at 2% stable for the past 35 years for the overall UK economy. We're talking about a 3 trillion economy, okay, now. So the fiscal authority creates an artificial, a preposterous, obnoxious price stability target, which is unachievable, okay, because prices, they move around quite rapidly, but with a lot of frequency every day in the all parts of the economy. So this 2% target, it has to be scrapped, chuck it in the bin. It's total bog monetary policy engineering. It's bog stuff, especially if it's a politician that pretends to know how monetary policy works. Yeah, it's just chuck it in the bin. Take the politician and the 2% paper and chuck both of them into the bin, because they are good at nothing, okay? So you need a solid macroeconomic modeling, empirical framework to decide how to manage inflation. And we see here that the reaction function we saw up until now, that the reaction function to aggregate demand, the central banks, it does not give a fuck. They don't care about GDP unless there is big recession. But then what happens when there is recession? They go and look for the labor market. Of course, you will see higher unemployment, and then it kicks in the reaction function, then we lower interest rate. But it's because of the full employment mandate. They don't do aggregate demand managing into the economy. Okay, they try, or at least they try not to do it. What they do is inflation expectation managing. Okay, which is another thing, right? So these are all very, very interesting things, which it showed me first. Not showed me first. We can prove me, and they can prove to you all. I hope you are listening and watching this video, and subscribe and leave a like. Give me a like. That basically the Phillips curve, it works differently in our modern days economy with high technology factor. And what is the total factor productivity? If we have GDP at 2%, but we have 4% in share of labor and technology, the total factor productivity is minus 2%. So what it means that our overall aggregate rate of growth is still too low. That's why we saw that productivity has shrunk, because in aggregate the economy has not improved, okay, vis-a-vis the technology improvements that we have, right? And so here we have the most modernized Phillips curve equation, yeah, where we have a gamma parameter which looks forward and backward to inflation expectation, pi t plus 1 or t minus 1 at a time t plus 1 or minus 1, and the other I cancel that one. And we have the slope of the curve, and we see that the slope of the curve is very flat, equals 0. The k parameter is very close to 0. We don't have a steep relation, linear relation between the workforce, so the aggregate demand, and the level of prices. And then we see how the model has converged, where is the DSGE model, the basic Phillips curve, the hybrid Phillips curve, which is the best model, the best fit model, and the extended model, okay, which has the the k parameter, all of that stuff that we like. And we have some scatter plots which interpolate the minus supply M2 growth with the level of unemployment, because we want to know at this point what happens if we print out money, if we have credit creation, whether it's the fiscal impulse or it's businesses which are borrowing at the corporate borrowing rate, what happens? Okay, because those factors are very important to be considered. Okay, so we saw, according to past data, the scatter plot tells us, okay, that even if the corporate bond rate is very low, or the spread is very low, we have a clustering. So unemployment can be anywhere between 4 and 10%. Okay, it can be very high unemployment, very low unemployment. Doesn't matter what is, it matters what is the corporate bond rate. I believe this would be also in terms of, okay, a credit spread. Yeah, we can measure the credit spread. But then it's very nice to see what happens between the money supply and employment or unemployment. So if we have, let's see, that higher money supply, it does not mean automatically that I will keep low unemployment, okay? Because the scatter plot tells us that we have very high unemployment with high level of money supply growth. I don't know why. Honestly, I don't have an answer for anything in the universe. But what we see here, that at a balance rate of 5% M2 growth, we have the most clustering of the unemployment rate, around 4% and up to 10%. Okay, so for very high levels of money supply, unemployment goes higher. Okay, so it does not mean, it can also capture data when we have a financial crisis. So unemployment is at 10%, and then we have an expansion of money supply, and then it takes time for unemployment, for people to find jobs. First of all, for new business to form, for new businesses, new economic activity to spring up again, and then you have employment. So that's why you can have a lot of money supply in a recession, for example, or in the aftermath of a recession, and you still have high unemployment. That can be a theoretical explanation of practical stuff in life. Now, money growth and employment rate. So we have the rate of employment. These are most clustered here, and we see that this rate of historical rate of employment have always worked with a money supply between -5 and 15%. Okay, whenever we go above the 15% money supply, we have lower rates of employment. So it mirrors again this here. High money supply, high unemployment. So printing money is not always a good thing. Yeah, it does not always lead to positive outcomes. And if we take the Fisher equation, which says that for money supply we have, or money velocity of money, we have inflation, and the Fisher equation tells us that for every point of inflation we have to hike interest rate, then printing money supply is not always a good thing. So what happens with credit spread? Okay. So we see here that if we have a compression of credit spread, we have high levels of employment. Okay? But then if credit spread starts to widen, we have lower levels of employment. So it means that we have corporate defaults, like First Brands, that we got the auto parts manufacturer, I don't know, in the United States, which has defaulted. And so we have wider credit spread, and we have lower levels of employment. So these are very interesting things. And we can see also the dynamic correlations between the inflation, the unemployment gap, which is the unemployment gap can be positive or negative if we have full employment, which is below the natural rate of unemployment. What that means, we have a negative unemployment gap. So UG, the unemployment gap, if it's smaller than 0 or is larger than 0, so if it's smaller than 0 and we have a negative unemployment gap, it means that it's good, because we have less unemployment than what we projected to be the natural level of unemployment. But if it's positive, if it's larger than 0, it means that the unemployment that we have into the economy, it's above what is our desired level of unemployment. So we have more people unemployed, and so it's negative. Plus is negative, negative is positive, so it's a bit of both. Okay, we can see these correlation measures across time. It will take a lot of time to interpret this data, but what we can take away as a concept is that the correlation level between, for example, PCE inflation and the unemployment gap, it has varied a lot across time. It depends on the business cycle. In some periods it was negatively correlated, some periods it was positively correlated to the employment gap. So it means that you can have a push up in inflation and also a positive unemployment gap. So you have higher inflation and higher unemployment, and which would be counterintuitively because both things, they are going into the same direction. But it can happen very, very easily as it happens now, for example, in the UK economy. Why this can happen? This can happen for a very, not a very simple thing, for a variety of factors, which can be stagflation, but what is a component that can create higher inflation and higher unemployment? So you have higher inflation, you have to be better off at the same time, better off work. It's because of fiscal policy. Okay, so what happens is that the government tendentially should be able to balance the budget, right? So there is as we have a household budget constraint, we have a government budget constraint. What happens is that when the government keeps printing persistently deficits, fiscal deficits, the only way to depreciate the deficit is to have higher inflation. Okay, so basically you can find yourself when you are doing deficit and you have high inflation and you have higher interest rate and you have higher higher cost of borrowing, okay? And so you have a higher rate of you have a constraining effect on the labor market. So fiscal deficit, they are not always good, because if you don't balance the budget, you put the economy into an overheating. It's too hot until basically all the mechanisms, they start to grind to a halt. Okay, so what is the government budget constraint? So I have the budget at t minus 1 and at the level of prices. Okay, and we have to bear in mind that the level of prices can jump if we have a fiscal policy response or an inflationary shock. So we have that basically the sum of from 0 to infinity of the primary surplus, the primary account surpluses. Okay, so that means that the sum of the primary surplus at time t plus s. Okay, every time there is a budget, we have a deficit or a surplus, fiscal deficit or a surplus. So the sum of all these events, so the sum of the deficit or the surpluses times a discount factor t at time t plus s, will tell us the level of nominal government debt. So if the government has accumulated a lot of deficit, or it has been able to balance the budget constraint between the budget and the level of prices, and so that the sum of all the fiscal policy measures, they are balanced to zero, to neutral, let's say. Okay, so when you have persistent deficit, what happens that the only way for the whole equation to work out, to hold, is that if this BT, the level of budget keeps going higher, so you have a larger numerator, to not blow up this whole ratio, also prices have to go up to keep in balance the ratio between the budget and the prices. But the budget is nothing else than the collection sum of all fiscal policy. And so that's why basically you can have a business cycle when prices are higher because they are driven by persistent fiscal deficits. And so you can have a positive correlation between PCE inflation, consumer spending, let's say, or inflation, and unemployment. So you have higher prices and higher unemployment gap. Why? Because the fiscal deficit is persistent. And the only way for the government to keep things in balance, to discount the present value of the deficit into the future, is to keep inflating away the debt. But having inflation higher, it requires to have higher interest rate. And so that push down employment. And what happens is that we have a unemployment gap, U of G, which is positive, which is larger than zero. Okay, so we have higher inflation, higher prices, which have to inflate away together with inflating fiscal deficit. We have higher inflation and higher positive unemployment gap. And so that could then become stagflation if it muddles through for a longer period of time. Then you are in stagflation when the economy does not have productivity growth and you have higher inflation, higher costs, because probably the borrowing costs are higher also for corporates, and basically there is no way I'm going to hire additional workers or new workers because the economy it's in a quagmire. And we see here just all these correlation factors, how it jumps up and down, above and below at zero in positive and negative correlation. Now we are in a period where we have a negative correlation coefficient, almost totally inverse correlation. So that means that we have a smaller unemployment gap, so the labor market it's keeping up in a healthy position, and we have a certain level of consumption. But we saw here that the curve has started turning. So it means that probably we are going into a business cycle where we have higher prices and also higher unemployment. So it means that the dynamic between the labor market and in the dynamic of prices, they are changing. They are changing. Why? Because probably one example is, going back to what I said before, it's tariffs, and it's the depreciation of the dollar. So I have an exogenous inflationary shock, which puts a constraint on my production function. So what happens is that I have higher inflation, which comes from my inputs, which are goods, and the cost of capital, because I have higher corporate borrowing rate, and so I have to lay off workers. So at the same time, I have higher inflation and higher unemployment. Okay, and that can be seen in the rolling correlation here, that it's going to change. It still is very, very negative. It's below minus 0.5, so still it's negative correlation. But that's how dynamically the variables adjust into the economy. They interact. But these variables are huge things moving. So the whole labor force in the United States is something like 170 million people. That's what we are talking about. Okay, so the dynamic correlation between inflation and employment, it's the level of prices, the goods and services measured in a 340 million people economy. The employment, the overall civilian workforce, it's north of 100, and it's roughly 170 million people. So in these charts, that's the whole thing, which is very, very nice. And with the data points, you can explain a lot, something very large. So very large things can be small things can be very large things. It's like E equals mc squared, right? In a very tiny mass, I can have a lot of energy, right? So in very small data points or in a chart, I can have a lot of things. So dynamic correlation between Fed funds and unemployment rate. So here we have positive correlation, and we can basically here from 2010 to 2012, we have a positive correlation. In fact, what happens? We know that the Federal Reserve lowered interest rate. It was already at zero, okay? And the yellow line, the gold line, is the corporate bond rate. It was 6% in 2008, 2009, and then it went down steadily, okay? And it kept in the range, yeah? And the purple line is money supply. These are the historical data from the Federal Reserve. At the same time, we have the red line here is the unemployment rate, okay? So we catch a positive correlation because Fed funds were very low and the unemployment rate was decreasing, was converging down, okay? Until we got to the lowest point here, 2019, 2020, very low, it was a negative unemployment gap because it was well below the natural level of unemployment. And here we see the opposite. The blue line is the level of employment, which was going down and then went up. And here we have the big shock of 2020, okay? And then we see the claw, how the claw charts evolves. So that's why we have a positive correlation here, which peaks. And then it goes into negative territory, and then we have a positive correlation in 2014, probably because there is a proactive stance of the Federal Reserve for the full employment mandate, and you have a positive correlation between the level of interest rate and unemployment. But then the zero lower bound has created what is an inverse correlation period, okay, from 2015 to 2016, so that basically the movements, they go into different direction. So the unemployment rate, the federal funds rate was kept lower, and then the unemployment rate could move around almost in the opposite direction. And here we see that in the past period we are having a positive correlation, which has changed into negative correlation coefficient. So it means that the very large rate of change, here we have an inflationary shock in 2022, so we have a very large rate of change in the Fed fund rate that basically pulls the unemployment factor with it, because it goes from 0 to 5% in a nanosecond, and so that created the positive correlate, because you want a tight monetary policy that has constrained also the labor market. Okay, so here we see that the correlation between money supply and the employment rate, it's always positive, always, apart from in the past period here. So that's interesting, because we see that there is a higher level of corporate borrowing. We have seen, we began to see the first defaults, first brand defaults. The delinquency rates in the economy, which is credit card, auto loans, are picking up, are increasing. So we are creating bad credit. So this credit cycle, we are in 2025. Let's say we are in 2005, okay? So we are in the bad credit cycle period. And this will pop up in 2027, in 2028, 2029. The whole bubble of AI and the capex expenditure into AI, which is highly unprofitable, and the bad credit bubble will implode for sure. So in this past period, we have a negative correlation between money supply and employment, which is noticeable. It's something to... here we have negative correlation coefficient between corporate rate and unemployment rate. So it means that I have higher corporate bond rate, lower unemployment, okay, which is not entirely consistent with our money supply and employment rate, because there are two different measures. But okay, this is starting to turn in a somewhat. But we see here that most of the period they move together. So if the cost of borrowing for corporate is pretty high, then it's difficult to have a healthy workforce, because it's costly to finance the business, and then I have to keep my EBITDA margin, and so I'm not hiring people, I'm not adding jobs. That's the magic thing. Okay, we can examine the impulse response function, sort of. So the response of inflation to monetary policy shock, we see that we have an expectation of inflation pricing in interest rate hikes, and then we have the tightening effect of monetary policy. So then here we have policy response to inflation, just straight for 12 following periods hiking interest rate. That's what we have seen in the past period. And then here we have a positive response of inflation to unemployment. So even if we have higher unemployment, probably we have higher inflation for some sort of strange reason. And then we see here the response of unemployment to monetary policy. Okay, so monetary unemployment can decrease, okay, if we have easing monetary policy, but also if we have a rate hiking cycle which is normalizing monetary policy, still it's a positive factor for the unemployment. Okay, so the response function is in the in lowering the unemployment rate. Okay, so that's all quite a lot to say. It's very, very interesting, and we have covered only a dynamic modeling of the interaction between prices and inflation, and we have tried to understand the fact that we are not in a 1950 or a 1970s economy when there is a very direct relation between the aggregate demand and the level of prices, But there are many other factors, because the financialization of the economy and the overall widening of global commerce and the adding of productive capacity on a global scale have changed, and all the technology factors, they have changed dramatically the engine. Okay, we have hybrid engines. We have hybrid engines, so the best model that we can use to estimate the Phillips curve is the hybrid new Keynesian Phillips curve, because the engine that we have now, the model that we have now, it's an hybrid model. It's a thermic, it's a internal combustion engine motors, and then we have the power unit motor, which is an electric motor, and we have to combine it together, and we can understand the dynamics into the whole economy, whether it's the level of employment and how and why prices are moving. Prices are not moving because we have a managing of aggregate demand from the central bank, but we have a managing only of inflation expectations and the level of employment into the economy. Prices are moving for other factors, which are inflation expectation, the technology components, or the other exogenous factor, which is the exchange rate, the global commerce, and all many other factors. So it is, in part, it is true that the Phillips curve construct, it does not reflect precisely what happens into the economy, and there is no direct relation between employment and prices. And that works the other way, because now we have inflationary shocks, but wages have stagnated for decades and decades. So we can see another interesting thing that I can take for you. We can see how doing some linear or less regression. I'll pick up the model that works best, which is this one, model 8. And what we can see here, it's on a ordinary least square regression, how, for example, the core PCE inflation, how does it work, core PCE inflation? And what we have seen is that core PCE inflation parameters have a linear regression ratio with the employment rate, the 4 weeks average jobless claims, the inflation expectation, and the PCE inflation with a lag. And here we have the p-values, so these are statistically significant. So what that means is that basically core consumer expenditure, it depends mostly on what are the coefficients of the employment, what is the level of employment into the economy, what happens with jobless claims, 4 weeks average jobless claims, what are inflation expectations, and what is PCE inflation with one lag, which is very, very, very reflective of the hybrid model of the Phillips curve, because we have forward-looking and backward-looking inflation expectation. So in this instance, we have inflation expectation and we have PCE with one lag. One is inflation expectation, one is a lagged parameter of PCE. So we are considering what something in the rear mirror and something that it's coming towards us or we are going towards to. And it's very, very similar to the Phillips curve. So what that means also is that we have as well a persistency of inflation, because the lagged inflation parameter tells us there is a persistence of inflation. And basically, we could try to put together the coefficients in a linear form. We can say that, for example, core PCE, our dependent variable, equals the lag coefficient, so 0.54 times the lag PCE. I'm sorry, I'm probably doing something which is not interesting. Plus the inflation expectation, let me put it here. So plus 0.2059 Okay, I think I will. So what I'm trying to say is basically is that core inflation equals the lagged inflation component coefficient plus the inflation expectation and the unemployment gap, which are the employment rate and the jobless claim coefficients. And that's another way of how those variables interpolate, interact with each other, and describe the dynamics of prices and the employment or unemployment levels in the weekly jobless claims. But what we see here is that the lag, the PCE inflation lag or the inflation expectation, these are larger factors, while the unemployment gap factor is very, very small. So still what is important for inflation is the persistency of prices. So the inflation shock, it has a persistency, and we can measure that with the, if we measure the conditional volatility of inflation, we will get to a parameter, like a beta parameter, that will tell us for how long prices will persist on once they receive an exogenous shock. We have an energy crisis, energy shock, for how long energy prices will be higher, so the persistency of inflation. And we see it here the same, the coefficient for the inflation expectation and the lagged PCE, they are larger compared to unemployment gap. So this, and the job, is the exponential to the power of 7, so or minus 7, so it's 7 zeros, 7 decimals after the 0. So it's a very, very, very small number. The coefficient of variance, the coefficient for which jobless claims interact with the core PCE. So what counts for inflation, it's actually the persistency of the lagged effect of inflation. What counts less is the level of unemployment. So also in a OLS regression, we can see together the same thing. So that for all the data that I collected, what counts is the level of prices. They reinforce themselves in a cycle of higher prices, clear higher price, and higher price in a spiral. You have a spiraling effect of inflation, which is not related to employment. So then it's difficult to manage the monetary policy response for that kind of thing. And so that's another interesting data point that I found out. And then we can see together a VECM model, probably. No, we can see another thing, just the results. Okay, because I can show you, we can see together what I've got here. Okay, we have a DSGE model and the NKPC models with the VAR. Okay, we are fitting the Phillips curve into the VAR model, and there are some optimal lags, etc. And the equation results, there are lots of pages, so we can jump and go to the results because it would take me a couple of days just to go through everything. And what we can see here is very, very interesting, is that the VAR model, it does not get at all the neutral level of interest rate or the dynamic of the Phillips curve in some forms. Also in the forecast. So we see here, let me figure it out somehow. We see that the vectorial autoregression model forecast with some lags, 8 lags, 12 lags. It does forecast very small parameters for what is the level of inflation here. Okay, probably because it's the forecast, the data point that gets out the VAR, it can be interpreted on a monthly frequency or on a quarter frequency. I think it's a monthly frequency. So what the forecast tells us that maybe there will be minus 0.16 on a month-over-month inflation, but that's not very reliable. Here we have to see the DSGE and the Phillips curve forecast for inflation, and we see that it will be around stable, 2.5 to 2.3%. But for what is October, the next month, you can see here 2025, November, October, December, and then whole 2026 up to September 2026. So this is the 12 months forecast. Okay, so what the dynamic model tells us is that inflation will be around 2.5, 2.3%, a little bit above the monetary policy target. And the VAR forecast tells us, okay, those will be potentially the month-on-month inflation data points that will come up. I don't think so, because it's impossible to forecast a month-on-month inflation data. But what we have here, we have the same parameters as before, only that the beta discount factor is it's a bit higher. So that means that the neutral level of interest rate, paradoxically, would be around 4%. Rather than 3.1%. And I hope that I can show you something else with for what concerns the neutral level of interest rate. Then the same here, we have a K parameter, so the slope of the Phillips curve is very, very flat, it's zero, almost zero. The risk aversion factor, it's as equal as before, it's a 50-50, so there is forward-looking component of inflation expectation and a backward-looking component of inflation expectation, and so we have an equal risk aversion to inflationary shock or to interest rate shocks and stuff like that. So here we have an elasticity parameter, and as usual we have a zero component for the output gap and a 1. So the reaction function of monetary policy to inflation is 1-to-1, so it's a very weak parameter that comes out from this model, which by no means it's a theoretical model, so it's by no means perfect. And then we have the same for the Phillips curve. We see here what are the slope parameter for the unemployment, the employment rate, or the jobless claims. They are very, very flat, very close to zero. So the slope factor between inflation and these other three parts of the economy, the labor market, unemployment, employment, and jobless claims, the slope factor, which is the derivative factor, it's very, very close to zero. And the beta discount factor, this is very high. It signals a consumer that is very, very impatient and prefers a lot more immediate consumption rather than postponing consumption. So that's another model that I've tried to calibrate in order to have some sort of ideas around how the different parameters would have been moving around. And we have here also forecast summary. So we see that basically in 3, 6, or 12 months time, the model expects the federal fund rate a small gradual decrease. So those are the percentages rate of change. That's by no means the federal fund rate. And we have negative unemployment gap and then slightly positive unemployment gap in 12 months time, and some sort of deflationary effects on PCE and core PCE, which are interesting variables. And so that's another very interesting model, and it's pulling together the VAR method with the dynamic modeling of the equation of the economy, of all the macroeconomic variables. And okay, so here we see how the inflation forecast model comparison, we see how the Phillips curve forecasts a higher trajectory of inflation, while the DSGE model, it's more linear, still is around a little bit less than 2.5, so we will go to 2.3%. The VAR model basically tracks the month-on-month percentage changes. That's why there is this discrepancy. And okay, these are the models projections, whether it's the DSGE model or the Phillips curve model. So we can observe what will be inflation, and we saw that would be higher and then descending. Then unemployment gap should narrow, and then jobless claims. These are very, very large. I don't know, there must be some probably some error or some sorts. I won't take it as reliable as they seem to be. In fact, we see here, for example, how the DSGE model projects a positive unemployment gap. So it means that unemployment will go up, inflation converging 2.3%. And yeah, it's wrong. I don't think interest rate will go up, and the output gap will be probably like the rate of employment will be stable. I mean, these models, they need calibration. So and if the model fits properly, and then we have to you have to triple 10 times see what is the mean absolute error, what is the log likelihood if the model fits, what are the standard errors, the p-values, so the statistical significance. So I don't assure you these are very, very precise, because I had to repeat it many times to calibrate the response function. And what I want to do is to go to the error correction model, if I find it, which is gonna take me a little bit. Just bear with me 1 second, chums. Yeah, so finally we got to the VAR correction models. VAR, VECM, this is the, it's not VAR, it's the vector error. One is the VAR, so it's the vectorial autoregressive model. So basically the data are transformed in column vectors, then we have matrices, and we have an autoregressive model of these matrices or vectors with applying some lags. Okay, so, and then that's why it's called VAR, so vectorial autoregressive model. Then if the VAR doesn't fit properly, then you can use the VECM, which is the vectorial error correction model. So that finds out what, it doesn't tell you what are the VAR error. Basically, it helps you to understand how, when there is a shock, a lag shock between two variables, how the variable correct their response with a certain lag. Okay, and so the this model, the with the error correction model, we are able to see the more precisely what are the dynamics in the labor market in aggregate. So because we have what is the civilian labor force, the employment, the civilian employment rate, total non-farm payroll, the average weekly hours, average hourly earnings. So we are able to measure to see what are the interaction between these parameters. And we see here that what it has is a significant sort of significant role, or a significant statistical value here is the, first of all, is the civilian unemployment rate. So what that means is that the civilian unemployment rate, which I believe corresponds to the U6, to the broader level of unemployment, it's an important measure to understand economic activity into the economy, and to understand what are the dynamics of average hourly earnings, and then what would be the GDP or inflation, and so forth and so on. So we find also that we have some sort of equilibria, which can be defined by the labor force minus the total non-farm employment and the unemployment rate. So overall, we take the labor force and we subtract the unemployment rate and the total non-farm rate of employment, and we find some sort of parameter which basically describes to us the relationship between the available workforce and what are the level of unemployment and the levels of non-farm payrolls, okay, so private sector jobs, right? And then we have also some sort of what is the capacity utilization of the intensity, labor intensity, relationship between the labor force and the weekly earnings and the hours worked. So we have unemployment. I'll try to make it easier also for me. Plus the total non-farm payrolls, plus the average weekly hours, minus the average weekly hour earnings, right? So we have this relation between the unemployment and the total farm payroll and the hours minus what are the compensation, the weekly hour earnings. So what are the compensation per hour, which can be $34, $35, $32 per hour, some sort of that thing. So here we see that the error correction model here tells us that the civilian unemployment variable in a VAR model, when there is a shock, it tends to correct with some lagged effect by this coefficient, okay, minus 0.42%. Now, if we see here, loading coefficients, alpha coefficient, because this model has a alpha and beta coefficients, like many econometrics theory, there are an alpha and a beta coefficient in a VECM model. The beta coefficient basically defines the co-integrating factors. So if I'm co-integrating in a vector column GDP and I don't know, inflation, so I know what is, or if I'm co-integrating GDP and yes, inflation, but PCE, personal consumption expenditure, so I can see the resulting from when I do co-integration. I have here just GDP, Y of t, and C of t parameters. Okay, I'm co-integrating in a vector column GDP and consumption. Okay, so I'm able to see how GDP varies with respect to consumption and vice versa. Okay, if GDP goes up, what happens to consumption and vice versa, and that's the beta parameter. Okay, so it puts together the co-integrating factors. The alpha parameter, it measures the speed of change, the rate of change in the co-integration factors. Okay, so in fact, what gives us here for the average weekly hours, we have here that there is a negative coefficient here for this p-value. What that means is that basically if the labor force and the level of the unemployment gap, when there is a shock, there is an adjustment in the hours worked. And the hours worked, it's negative. So that means that the employer asks the worker to work less hours. And we can see that by observing how the alpha parameter, so the rate of change between the two co-integrating factor, let's say is here we are, because here we are co-integrating more variables, I just put two. I have the labor force, okay, and the I don't know, the average weekly hours, or let's say the unemployment rate and the average weekly hours worked. I'm co-integrating these two factors. So when the unemployment rate goes up, I hope I'm explaining it properly. If I make a mistake, I apologize. But I see that these two factors co-integrates in a column vector, then it's a matrix, because those are matrices, because there are many variables, many factors. And the alpha coefficient that results is minus 0.56 or 0.57. What that means is that if unemployment goes up, what happens is that the average weekly hours tend to decrease by adjust by 0.57. So if I have a shock in one of the co-integrating factors, the coefficient, the error coefficient response, it's that parameter. Okay, and the same is for the hourly earnings. Here we see here that we have a small negative parameter, minus 0.55, which means that the magnitude of the adjustment when there is a lagged effect in the co-integrating factors works also in the measure that the average weekly earnings, they tend to decrease. So the employer adjusts the pay downwards. Instead of being $34 an hour, it's $32 an hour. So there is an adjustment. Whenever there is a shock in the labor market, automatically we will see also in the in the data that come out in the weekly or monthly reports, when we see that the average weekly hours have gone up or down, is because they have adjusted to other parts of the labor market. And tendentially, when there is a shock in the labor market, the workers are working less hours, and the average weekly earnings or the average hourly earnings, they are adjusted downwards. Okay, so, and also the same is for the, as I said before, the civilian unemployment also has some a negative parameter here. So we have a relation between what is the labor force, the level of total non-farm payrolls or non-farm employment, and then when we co-integrate this factor, we see how, when there is a shock, how variables adjust, how the error, let's say the error is corrected in a sense that perhaps, I don't know, post-pandemic we have job offerings of $40, $50 an hour, then the labor force starts to adjust because there is less demand for workers, and then we see that the average hourly earnings, instead of being $40, they become $34, and then they become $32, they become $30, so forth and so on. So when we have some deviation from some equilibria, then we are able to measure the adjustment in the many different variables of our VAR models equation or the error correction model equations, and something like that. What it tells us is there are short-run dynamics relationship in the labor market between the level of employment in the private sector, non-farm employment, also in the public sector eventually, and what are the average weekly hours worked or the average weekly earnings. So there is a much significance in this model, because it tells us what are the short-term dynamics in the labor market. It can be total non-farm employment, or it can be civilian unemployment. For example, we see that weekly hourly earnings, they adjust for civilian unemployment, and basically if civilian unemployment goes up, we have negative weekly earnings. So it's very, very interesting, and it explains us how the labor market, in a sense, has its own dynamics, which are not directly correlated with the level of prices. And most importantly is that the dynamics of the Phillips curve have changed a lot, because we have a dynamic engine motor, which is internal combustion engine, and it's a electric motor power unit. So we have inflation, we have employment, and then we have imports and exports tariffs, or we have interest rate, or we have corporate rate of borrowing, and we have fiscal policy. And so it's a dynamic system, and so there is no straight immediate linear relation between the level of prices and the level of occupation or employment, or the level of labor force in the economy. So the demand side of the economy, it's important, but it's not so relevant unless there are very huge shock of demand. What counts are all these other variables that we have into the economy, which are, for the United States economy, is the level of asset prices, how people feel wealthy because their stock prices are generating capital gains, or the level of house prices and stuff like that. So the Phillips curve construct is a small part in a wider dynamic system, and we can see here that in isolation the job market has its own dynamics, which are not related to inflation, but perhaps are related to how much is the hourly pay. Is it $30? Is it $40? Is it $35? And how the hourly earnings adjust on average if I have a shock in the non-farm employment levels. So this leads me to another thing, is that rewiring back all my discourse here, is that we measure sometimes, especially when it concerns the Phillips curve, we measure output, okay, as a difference of prices. How we measure GDP, the quantity of goods and services that we have consumed into a whole economy. So measuring the overall output of goods and services, it depends if we are measuring the quantity. I produce more goods and services, but I can measure the difference in prices. So if prices are higher this year than the year before, paradoxically, I can have higher GDP, which is measured on prices. But as we have seen, the level of the workforce, what happens in the jobs market and how much people are paid, is not directly related to the level of prices. So I can have a strong GDP and have, probably low wages or wages which are not catching up with inflation, or I have wage suppression because I keep interest rate at zero for 10 years. So I have a stagnating effect on wages in some kind of economies, in some countries, or I have a depressive effect of wages for what has been, for example, the south of Europe. So where wages basically have lost purchasing power in the past decade or more vis-a-vis the level of GDP and the level of prices. Okay, so the way we are measuring GDP, I don't want to say it's wrong because I'm nobody, but eventually there should be a better measure, a better way to measure GDP, which is not strictly related to the level of prices. Because that doesn't capture what is the technology factor and what is the productivity factor, or if effectively people are in work, or what is the quality of the work they are doing, so forth and so on. So the classic GDP formula is consumption plus investment plus government plus the net trade balance, import and export. Okay, so here we have consumption, which is a big component, okay? Because for the multiplier effect, so if my marginal propensity to consume, it's if I have a wage and I consume 70% of the wage, so I have a multiplier effect 1 minus 0.7, okay? And then I have 1 over 0.3. So what happens is that the consumption component, because of the multiplier effect into the economy, it has a larger prominence in the dynamic of the GDP compared to investment, okay? Because if I'm consuming 0.7, I have only 0.3 for saving, which equals investment, of course. That goes for the, basically, I don't know if it's all saving and then becomes investment, but it's a very, very tiny part. It's less than 50%, okay? So the way the economy works is very too much skewed towards consumption, and even more when we have an economy which is skewed on services. So I'm sending you experiences of stock market speculation, or the speculation, or the wannabe venture capitalist startup creator. So basically speculation of pipe dreams, of these magic multimillionaire jobs, which are completely unreal, basically. And that's why the economy doesn't work really properly, because we are measuring mostly the effect of prices, but we don't produce anything. We are skewed towards consumption, and what we produce is services, which is not actually plates and tables and chairs, and we produce software or all immaterial stuff, okay? So that's a small thing that should be food for thought for how we should design the economy in the 21st century, considering that we have a very huge component part, which is the technology factor. As I was saying, the production function, I made a mistake, I made it very roughly before, but almost we have the capital factor and the labor factor, the technology factor, and how much we allocate to capital and labor, okay? But in this instance, when we have a lot of technological component, we will have less and less labor, and we will have less and less consumption. So that will basically shrink GDP and also shrink government, because we will have less government revenue. If we have higher unemployment because of artificial intelligence, there will be less consumption and less government revenue. So the whole GDP system blows up. It goes out of the window. Okay, so that's why there is an academic need to rethink better how we measure GDP, because I can measure GDP in producing tobacco or alcohol, but that's an ethical sphere. Those are bad things. Okay, I can make money by damaging other people. I produce weapons. Okay, is that good or bad for GDP? Oh, I don't know. If you see the Lockheed Martin market capitalization, it's 200% up. Is that good or bad? So that's another ethical argument for what concerns how we measure GDP and what are our intention in structuring a society that works in a certain way. Not in a certain way, that works in a way that it's not damaging for somebody else. That my freedom of doing something is basically damaging. I grow because somebody else is not growing. Okay, so that's why we have been in a long period of stagnation because of many different factors. I don't know, GDP that is measured on consumption, that the labor market, it doesn't keep up with the technology advances, and so that some kind of employments are remunerated less and less and less, while some advanced kind of employment, I don't know, I do a software or I'm an AI engineer, I'm paid $100 an hour. So these are all a distortion in the system equilibria that create then more problems down the road. And my puzzle is really what will happen to the labor market in the future if we have the constraint of the technological factor in the economy, basically, that is gonna slowly substitute or compress the need for workers in jobs that are made with software that can be automated. Okay, I don't need somebody who codes Python because I can do it on my own, basically. So those are my simple questions, and I reckon that I will have probably a lot more to say. So if you bear with me, I want to show you what we have seen from the beginning. The beta parameter of the DSGE model, how the reaction function of the central banks, how they go into a theoretical framework model that can measure what will be theoretically the level of interest rate. Because we have estimated so many parameters before, the discount factor, what is the slope of the Phillips curve, we saw that the slope of the Phillips curve is very, very flat, so the Federal Reserve can manage interest rate without considering managing aggregate demand into the economy. And so even if, for example, wages are stagnating and inflation runs above the target for a long time, the Federal Reserve can suppress interest rate or keep carrying on the negative real rate of borrowing, because it does not manage the aggregate demand side in the economy, and it does not specifically looks into the level of compensation of employers and stuff like that, unless they are Federal Reserve employees. But before, as I said, we have this conundrum problem of the production function and how we measure GDP. So I'll repeat it again. Okay, so if the share of labor will decrease a lot more, so how are we going to measure potential GDP if we have basically the expectation of what will be the alpha parameter of capital plus 1 minus alpha, the share of labor at time t in the market, and A of t. Okay, so we can roughly show this arithmetic formula to say, okay, we can measure potential GDP as the sum of the technology component, the capital allocation component, and the labor component. But if the labor component in 30, 40 years, probably in 20 years, will tend to shrink because we are automating in an economy made of services, we are automating these services or part of these services, even the industrial production. So how we are going to measure GDP will collapse basically, and regardless of prices, okay, because prices can keep certain levels regardless of the level of employment, because we know now that there is no immediate strong short-term ratio between employment, unemployment, and prices. So the Phillips curve doesn't work so strongly as before, because we have a hybrid economic engine which is made of combustion engine and electric engine. So the labor input component tends to shrink because we have automated the processes of producing cars, yeah, or doing softwares. So now, going back to the parameters that we saw before, we can, for some strange reason, measure what would be, in theory, the level of interest rate of the Federal Reserve vis-a-vis what is the level of interest rate now in the future. So I'm trying to to make space here, because that's the only space we got. And we remember that the beta parameter, which is not the VECM parameter, our beta, we had the beta parameter that was 97.9, okay? That's the discount factor, so how the household budget constraints discounts the value of the dollar today, tomorrow. Consumption tomorrow, today. Am I keeping the dollar today? What is the value of the dollar tomorrow? Is 97 cents, so I'll keep it. I'm a patient household, and I keep tight my budget constraint, okay? So then we saw that we have a K parameter, which is the slope of the Phillips curve. And we knew that the slope of the Phillips curve was very, very flat. So we were around 0.0447 for the DSGE model. Then we have some other parameters for the the hybrid Phillips curve model. But nevertheless, we are in that situation, okay? And then we had those parameters that they were telling us, okay, the Federal Reserve reaction to the inflation gap equals 1.164, okay? The reaction to the output gap is 0. So if we take this stuff and we plug it in the Taylor rule formula, okay, we want to know the level of interest rate. We know that the discount factor that we found with our DSGE model is 0.979379. Let's keep it to 3 decimals. And basically this factor discounts the level of interest rate in the previous period, t minus 1, okay? This is a horrible Taylor rule formula, but okay, we want to know what would be theoretically the interest rate now. We have a discount factor for the past level of interest rate, plus our slope parameter, probably. Then it's plus basically the adjustment speed, which is nothing less than 1 minus beta, our discount factor. So it's 0.0207, which is theoretically multiplied by what? The 1.16, which is the reaction function parameter for the inflation gap that we have estimated, times pi of t, which will be our inflation target of 2%. Okay, and well, let me, okay, this goes all together. So I've taken a lot of space. So this K parameter is, this parameter here, 0.0447, it's nothing less than the slope of the Phillips curve, which is not the same as the 0.02 parameter, which it's the smoothing factor of how the monetary policy responds to the inflation gap. Okay, so basically here we will end up with what? 0.979 let's call it I, although it's I at t minus 1, plus, if we do the multiplication here, 0.0207 times 1.16, I've done this before, so I have already made, it's 0.0241 times what is, which should be the current inflation rate, let's say. Okay, so if we move this on the other side, we'll have I minus 0.979I equals 0.0241 pi of t. And basically we end up with a ratio that will give us some sort of other parameter. And if we do, we will find out that 0.0241 divided 0.0207 equals exactly 1.16. Okay, so not to bring it about for so too long, if we multiply 1.16 by 2, we will have that basically I should equal this number, 2.33%. So theoretically, the level of inflation for these parameters plugged in the thing would be, the neutral level of inflation would be around 2.33%. But we know that we have this beta parameter here, and we have calculated before that R, it's 1 over beta minus 1, which equal to 3.1%. So it means that probably we will have a range of neutral level of interest rate that is between 2.3% and 3.1%, sort of. Okay, but another thing is that we know that the K parameter, so the ratio between inflation, and unemployment, the slope of the curve is very flat. So it doesn't matter probably the level, not so much of unemployment, but of weekly earnings vis-a-vis the level of inflation that fits into the interest rate level. So basically the central banks can keep low level of interest rate even if inflation is higher because they are suppressing wages. It's called basically the like long-term stagnation environment. In fact, we saw that productivity in the economy has lagged back a lot. Productivity doesn't grow, what grows its prices, and we measure GDP basically if prices have grown, if the prices of goods and services have grown more than the year before, rather than the aggregate output, if we are more productive or we are producing more goods in a certain sense. That's why it's very important to understand what kind of economic framework we want to have. Should we have a 12-cylinder or a 10-cylinder combustion engine, or we want the hybrid engine system, economic system, or otherwise, do we want lower real interest rate, negative real interest rate, and prefer consumption, or we want higher level of interest rate and divert the monetary policy towards investment rather than consumption. So now I can show you another thing, is that I have my own estimates of the what would be theoretically the Federal Reserve neutral level of interest rate. With this modeling, I have modeled here how the average investment grade corporate bonds, neutral level of interest rate, would vis-a-vis work compared to the traditional Fed funds rate behavior. And basically I've estimated that, of course, the investment grade corporate bonds interest rate, naturally it brings a higher neutral level of interest rate, because corporate bonds are the rate of borrowing for businesses. But we saw before that the level of employment and unemployment are more related to what is the cost of borrowing or the money supply, even if there is an excess of money supply, rather than to prices. Okay, so if I have a predictable or I have a negative corporate spread, credit spread, I have consistent level of employment. That's why in another econometric model, I figured out, I said, okay, I want to measure what is the neutral level of interest rate from a time series perspective of the investment grade corporate bonds vis-a-vis the Fed fund rate, because the Fed fund rate tendentially it keeps the real rate of borrowing negative, because their trade-off, their monetary policy is to keep basically is very, very accommodative. So they want to keep interest rate as low as possible and focus on the inflation and on full employment, but not managing the demand side. Okay, so if basically they manage to engineer a higher GDP growth, which is fueled only by prices, it doesn't matter if wages are stagnating. And this explains how and why now there are, especially in Europe, there are a lot of reactions to wages stagnation, to income stagnation, which have been stagnating for the past 10-15 years. And so we see what is the effect of monetary policy in a decade term, in 2 decades, in more than one business cycle, so that we try to manage, the central bank tries to manage inflation expectations, and it likes to run the economy hot in some sense, so that there's GDP growth. It doesn't care about the demand side of the economy, because spending is good, but it doesn't care on the level of wages, because by definition, because the Phillips curve slope is very flat, you don't run the risk of having a catch-up effect, push-pull effect between prices and wages, as it was in the 1970s. And at the same time, you keep interest rate as neutral or as compressed as possible, so that you have negative real interest rate for a long time. But then you have, and that's the whole system that has worked since after the great financial crisis. That's why now we find ourselves with stagnating wages for more than a decade, not in the United States probably, or probably in the United States for certain industries or other stuff like that, but probably in Europe. We have a lot, for a long time we have experienced stagnating wages. The same is in the UK, while inflation has drifted above target for a long time. And so the cumulative cost of inflation basically comes to a point now which has screwed up everything, because now all workers categories have been asking for higher wages. I'm trying to gather back my pen and paper disaster. Bear with me 1 second. I don't think you have... yeah, finally got back to this. And we can see here how our beta parameter 3.1 is very, very similar. I'm sorry to do this very practical thing. Okay, we have a beta estimate here that brought us a 3.1% level of interest rate, which is very, very similar to the corporate rate of borrowing that I have estimated in the other work that I've carried through. So here I have interpolated all the interest rate time series Was here corporate AAA, BA, and BAA, corporate investment grade. Then what was the prime loan rate, high yield, investment grade, and real GDP, potential GDP, the unemployment, also macroeconomic variables with the Fed fund rate, and the 2-year and the 10-year treasury. So whole bunch of things that I managed to put together with the help of AI, of course. And the modeling works out that the neutral level of interest rate if we account for corporate bonds, investment grade, it's somewhere here, which is 3%, 3.5%. So what that means is that if the Federal Reserve would follow the Taylor rule, it will go to 2.5% per se. But that 2.5% in real terms would be an accommodative monetary policy and would be not adequate to the level of inflation. So it would be repeating the same thing that we have runaway inflation, and we have basically, we are not managing aggregate demand, and so we are not constraining consumption in some method to skew basically money towards investment rather than consumption. And to do that, basically we must have higher productivity, and that means that we must have higher wages. But if we just consider that people have to have the same income for the past 10, 20 years and go and go shopping, and indeed to do shopping they need to pile up on credit cards, that's where we end up. Now we will end up in a credit crunch, basically, because we see that auto loans and the credit cards, the default rates are going higher. So that's why my own idea is that the real level of interest rate should be set by observing what is the behavior in the corporate bond market, to see how businesses, they price to each other the cost of borrowing, which is the risk of lending money to a business which tomorrow can be insolvent, okay, or down the line can be insolvent, right? Like First Brands, yeah, they have 1 billion in assets and 11 billions in a line of credit, so they are bankrupt. And why that happens? Because interest rates have been kept artificially low for too long time. And even if we go to 2.5% Fed funds rate, effectively, it's not really restrictive. Okay, I don't want to say it's wrong, because I'm nobody. But in mathematical terms, in real terms, in empirical terms, it's not truly restrictive. Because we have, we have lower wages eventually, or we have some parts of the economy which have higher wages, and vast part of the economy which work on the minimum wage. That can be the United States, or can be Europe, or even worse in Europe. If you go to Italy, where I'm based, Italian workers, or the middle income in Italy, they have lost purchasing power, but a lot of purchasing power since the past decade or more. So even if wages now are higher than 10 years before on a nominal terms, on a purchasing power terms they are lower. But some wages, they are lower than 10 years ago. It's obnoxious. It's terrible what has happened. But why this stuff has happened? Because we have skewed the economic engine towards consumption, and we have not optimized for productivity. And we measure GDP. We measure GDP for basically for how much prices are growing. Okay, now we can see here we have the effective parameters. We read it together. Okay, so we see if we assume the composite corporate rate of borrowing, the estimate neutral level of interest rate, it's 3.12%, which is exactly this one, the beta parameter that we have of 0.979. So if I do 1 over beta minus 1, I have a factor. If I square it, if I bring it to the fourth power, I have 3.1%. Let's do it together. Let's see if I manage to do it together. I hope for me that's very, very interesting, because I'm talking alone since a long time. So 1 over beta, 1 over 0.979 minus 1, okay, this parameter. Okay, my plus 1. Let's see if we raise it to the power of 4. No, I did it another way. Probably I'm wrong. Anyway, we know that from the DSGE model, the beta parameter, so what is the discount factor of the household budget constraint, also for the interest rate level, we have a 3.1 level of interest rate. And if I go and check my model of trying to estimate the neutral level of interest rate from the investment grade corporate bonds, I have 3.12% now, while before 2008, the level was 3.5%, okay? And the average vol post 2020, it's 1.32%. So we have some measure of standard deviation there, okay? So we can see here that the traditional Fed fund rate will be 1.7%, very, very low, very, very low neutral rate. And so that brings me to the fact that the neutral level of interest rate in the economy effectively is the corporate bond rate, not the federal. The federal funds rate is a short-term money market, but then even treasuries, they are traded in the market. But what is the fuel of the economic engine is the corporate bond rate, the investment grade corporate bond rate. So that basically helps me to rethink the whole monetary policy construct, because probably the Taylor rule should be made in a different way, like should be a dynamic Taylor rule, and we can estimate the parameters by estimating what is the conditional volatility of inflation, and assuming that the Taylor rule works in the same way, but the adjustment parameter is the conditional volatility of the inflation and the conditional volatility of the output gap, rather than having a discount factor. So there is a whole plethora of things. That's all. I hope you enjoyed this the video. Just put a like if you can, and I'll see you in the next video and next content. You can find this content also on Spotify. I have a website where I write some articles about economics and whatnot. So you can, if you are interested, drop a comment, send me an email, or anything that you like, and hope for the best. Peace, and see you soon.